Let's talk today about something that we get a lot of questions about that people don't realize their mortgage can do, and that is lines of credit. With OSFI coming out that they want to make some adjustments again to lines of credit, obviously this is a hot topic once again on what could be done or not done. So, listen, how it works is that in Canada, you must have you must have at least 80% value in your house secured by mortgage before you can even think of a line of credit. So my house is worth 100 grand. I have to have $80,000 can be secured by the combination of a mortgage or a line of credit. But the deal here is that only 65% can be secured by a line of credit. So, for example, I have a house worth $100,000. I can put 15,000 of that must be in a fixed payment mortgage. $65,000 of that can be in a line of credit. And so that is the first thing. So a lot of times when people ask about lines of credit, they simply don't have the equity to do that. So that's the first threshold. Now, there's a number of different lines of credit that exist. One line of credit is just a separate second mortgage. And so I have a mortgage of $200,000, I have a line of credit at $100,000, and I use that as a regular credit facility. How a line of credit works is that I don't pay anything on it until I use it, and I put $10,000. I pay interest only. It's open to pay off at any time. It doesn't cost me anything to pay it off, so there can be some reasons where that's strategic to use. And as I pay it off, the balance is available to me, just like a credit card or credit line, because that's what it is, a credit line. That's the first way it can be arranged. The second way it can be arranged is what's called a running account. A lot of products use like this, and this means that as I pay down my mortgage, it automatically becomes a line of credit. So as I pay down, if my payment's $1,500 or $1,000 of it is principal, then $5,000 of it becomes, or $1,000 becomes part of my new line of credit, and that's automatically available to me. So we do that for a lot of clients, but again, has to work from that perspective. Lines of credit are more expensive than a variable rate mortgage. So if I take a mortgage and if I'm doing renos and I am going to need 100 grand, I'm probably going to want to put it into a mortgage and not just into a line of credit, because that is going to cost me more over time. But a line of credit is fully open, and so I don't pay on it if I don't use it. So there can be reasons to use it. We definitely do them all the time. I have one, clients have one, but they have to be used strategically and on purpose. Now, where a line of credit can also get tricky is if I'm buying multiple properties, I have to use that payment as being a much higher payment. That's going to significantly reduce my borrowing capacity if I go buy other properties. So you might not know your mortgage can do that, but this is another thing your mortgage can do. So if you want to talk about an option for that and what that would look like, please do reach out to us. We'd be happy to help you with that. Thank you so much. We'll talk to you soon.